Imagine a sudden financial storm sweeping across an entire region, threatening to unravel years of economic progress and stability. In the midst of the 1997 Asian financial crisis, when many countries turned to the International Monetary Fund for help, Malaysia chose a distinctly different and controversial path. Instead of embracing the austerity measures and interest rate hikes recommended by the IMF, Malaysia implemented stringent capital controls and fixed its currency, opting to chart its own course out of the crisis. Malaysia's government, led by Prime Minister Mahathir Mohamad, fundamentally disagreed with the IMF's diagnosis and prescribed remedies. They viewed the crisis not as a consequence of deep structural economic flaws, but primarily as a result of speculative attacks on their currency, the ringgit, by foreign short-term capital. Their core belief was that these rapid and destabilizing capital outflows were draining liquidity from their economy and hindering their ability to recover. By rejecting the IMF's approach, Malaysia sought to regain monetary policy autonomy and protect its domestic industries from fire sales to foreign entities. To achieve this, Malaysia enacted a comprehensive package of capital controls in September 1998. Key measures included pegging the Malaysian ringgit to the United States dollar at a fixed exchange rate of 3.80, thereby eliminating currency speculation. They also restricted the offshore trading of the ringgit, making it difficult for speculators to drive down its value. Furthermore, a one-year holding period was imposed on foreign portfolio investments, essentially locking in short-term capital and disincentivizing sudden withdrawals. These controls allowed Malaysia to lower interest rates and pump liquidity back into the financial system, stimulating domestic demand and investment. This bold strategy directly challenged the prevailing orthodoxy of free capital movement, and it became a significant point of debate among economists and policymakers globally. Malaysia's actions were seen by some as a dangerous precedent, potentially signaling a retreat from globalization, while others lauded it as a pragmatic defense against what they perceived as the IMF's one-size-fits-all approach. The controls provided a much-needed period of stability, shielding the economy from external shocks and allowing domestic recovery without the social and economic costs often associated with IMF programs. This enabled Malaysia to avoid selling off strategic national assets and maintain control over its economic destiny, an outcome fiercely desired by its leadership. Ultimately, Malaysia's unique response demonstrated that there could be an alternative to conventional crisis management during extreme financial turbulence. By insulating its economy from speculative pressures and maintaining an independent monetary policy, the nation managed to navigate the crisis, protecting its financial system and fostering a recovery that was largely driven by domestic initiatives. This approach highlighted the complex interplay between national sovereignty, global finance, and the often difficult choices countries face during times of economic distress, providing a crucial case study in economic resilience.